For the first time in modern history, the United States government is not the largest borrower in its own bond market. In 2026, American corporations are on track to issue $2.25 trillion in investment-grade debt. That is more than the federal government will borrow in many quarters, and both of them are fighting for the same pool of buyers. In this video, I'm going to explain why this collision of borrowers is quietly reshaping interest rates, mortgage costs, and the stability of the entire American financial system. Because when two giants compete for capital, someone has to lose. The Treasury Department just reported that federal debt has crossed $38 trillion. But the real story is not the size of the debt. It is who is willing to buy it and at what price. There is a phrase in economics that most people never hear outside of graduate seminars. It is called crowding out, and it describes a phenomenon where government borrowing absorbs so much available capital that private businesses cannot find investors for their own projects. For decades, economists warned this could happen, but the opposite is now occurring. Private companies, especially technology giants building infrastructure for artificial intelligence, are issuing so much debt that they are beginning to crowd out the government. The Treasury Department, which funds the daily operations of the United States, is now in direct competition with Microsoft, Amazon, Google, and dozens of other corporations for the same fixed-income investors. This is not a theoretical concern. Apollo Global Management's chief economist, Torsten Slok, released a note in recent days quantifying the problem. Wall Street estimates suggest investment-grade corporate bond issuance will reach as high as $2.25 trillion in 2026. That number represents one of the largest private borrowing surges in American financial history, and it is being driven almost entirely by one sector: artificial intelligence infrastructure. The hyperscalers, the massive cloud computing companies that underpin the modern internet, are raising capital at an unprecedented pace. They need data centers, they need power infrastructure, they need cooling systems and semiconductor fabrication partnerships and real estate in every major metropolitan area on Earth. All of that requires money, and the bond market is where they are getting it. The question Slok raised is deceptively simple. Who will be the marginal buyer? When there is $2 trillion of corporate debt and another trillion or more of Treasury debt all coming to market in the same year, where does the money come from? There are only three possibilities. Investors could sell their existing Treasury holdings to buy corporate bonds, which would push government interest rates higher. Investors could sell their mortgage-backed securities to buy corporate bonds, which would push mortgage rates higher for American homeowners. Or new money could enter the system, which would require either higher yields to attract that capital or central bank intervention to create it. None of those outcomes is painless. To understand why this matters, you need to understand how the bond market actually functions. When you hear that the 10-year Treasury yield is 4.5%, that number is not set by the Federal Reserve. It is set by supply and demand. The Treasury Department announces how much debt it needs to sell, and investors bid for that debt. If there are more bonds than buyers, prices fall and yields rise. If there are more buyers than bonds, prices rise and yields fall. For most of the past 40 years, the United States had an artificial advantage in this market. Foreign central banks, particularly those in China, Japan, and the oil-exporting nations of the Middle East, purchased enormous quantities of Treasury bonds. They did this not primarily for yield, but for strategic reasons. Holding dollars maintained currency pegs. Recycling trade surpluses into American debt was a form of economic diplomacy, and parking foreign reserves in treasuries was simply what nations did. At the peak of this era, foreign governments held more than 40% of all outstanding treasury debt. That number has now fallen below 15%. This shift has been gradual but relentless, and it fundamentally changes the dynamics of American borrowing. When foreign central banks were the dominant buyers, they were price insensitive. They would purchase treasuries regardless of whether yields were 2% or 5%, because yield was not their primary motivation. This allowed the United States to borrow at what economists call artificially low rates. The demand was guaranteed before the auction even opened. Private investors do not operate this way. Hedge funds, pension funds, insurance companies, and asset managers are profit-driven. They compare treasury yields to corporate bond yields, to mortgage-backed security yields, to dividend yields on equities, to returns on private credit. If treasuries do not offer sufficient compensation for the risk and opportunity cost, these investors simply buy something else. This is the world the Treasury Department now inhabits, and it is entering this world at precisely the moment when competition for capital is intensifying. The federal government borrowed $601 billion in the first 3 months of fiscal year 2026, which began in October. That is $110 billion less than the same period a year earlier, largely because tariff revenues temporarily boosted income, but several factors suggest deficits will widen significantly as the year progresses. The Supreme Court may invalidate portions of the current tariff structure, removing that revenue source. The tax season will bring a surge of refunds from new tax cuts passed under recent legislation, and the administration has announced plans to increase defense spending from $1 trillion to $1.5 trillion annually. Meanwhile, the interest the government pays on its existing debt continues to compound. Despite the Federal Reserve cutting rates 3 times last autumn, long-term Treasury yields have barely moved. The 10-year yield sits roughly where it was in early September. The government is not getting relief on its borrowing costs. This creates a compounding problem. Higher interest payments increase the deficit. Larger deficits require more borrowing. More borrowing increases competition for capital. Competition for capital pushes yields higher, and higher yields increase interest payments further. The Congressional Budget Office projects that interest expense will consume an ever larger share of federal revenue over the coming decade. At current trajectories, debt service could exceed defense spending within 5 years. There is a phrase that rarely appears in mainstream financial coverage, but it is increasingly discussed in central banking circles. That phrase is fiscal dominance. Fiscal dominance occurs when a government's borrowing needs become so large that the central bank loses its independence. The Federal Reserve's primary mandate is to maintain price stability to control inflation. But if the Treasury cannot find enough private buyers for its debt, the Federal Reserve may be forced to step in and purchase that debt directly, effectively printing money to finance government operations. This is not a theoretical concern raised by fringe economists. Former Treasury Secretary Janet Yellen warned of exactly this risk at a panel hosted by the American Economic Association just days ago. She stated plainly that the preconditions for fiscal dominance are clearly strengthening. She noted that federal debt is on a trajectory toward 150% of GDP over the next 3 decades. For context, debt to GDP was approximately 35% in 1980. It crossed 100% during the pandemic. The direction is unmistakable. What makes fiscal dominance so dangerous is that it undermines the credibility of the currency itself. If investors believe the Federal Reserve will ultimately be forced to monetize government debt to create dollars out of nothing to buy Treasury bonds no one else wants, they will demand higher yields. As compensation for that inflation risk, this creates a self-reinforcing spiral where fear of monetization causes higher rates, which causes larger deficits, which increases the probability of eventual monetization. Japan has operated under a form of fiscal dominance for decades, with its central bank owning more than half of all government bonds. But Japan had unique circumstances: a massive domestic savings pool, a current account surplus, and a population willing to hold government debt at near zero yields for decades. The United States has none of these advantages. What most observers miss is how the changing composition of Treasury holders accelerates this risk. When foreign central banks held 40% of Treasury debt, they provided a stabilizing buffer during market stress. During the 2008 financial crisis and the 2020 pandemic crash, these holders did not panic sell. They held their positions or even increased them, providing liquidity when private markets froze. Profit-driven investors behaved differently. During the March 2020 Treasury market dislocation, hedge funds and leveraged investors dumped bonds en masse, creating the largest Treasury market dysfunction in decades. The Federal Reserve was forced to intervene with trillions of dollars in purchases to restore order. If another crisis occurs, and crises always occur, the Treasury market will be more fragile than at any point in modern history. The stabilizing bloc of price-insensitive foreign central banks has shrunk to a fraction of its former size. The marginal buyer is now a hedge fund running basis trades or a pension fund, comparing yields to corporate alternatives. This fragility has implications far beyond the bond market. Treasury yields serve as the benchmark for virtually all borrowing costs in the American economy. Mortgage rates are tied to them. corporate borrowing costs are spread above them. Student loans, auto loans, and credit card rates all ultimately derive from the risk-free rate that treasuries are supposed to represent. When $2 trillion of corporate bonds compete with $1 trillion of treasury bonds for the same pool of capital, someone pays a higher rate. If treasury yields rise, every borrower in America pays more. If corporate spreads widen, business investment slows. If mortgage spreads increase, housing becomes less affordable and existing homeowners lose equity. There is no scenario in which this competition is absorbed without consequences. And this connects to a broader shift in global capital allocation that few are discussing. For decades, the United States attracted foreign capital because it offered something no other nation could: deep liquid markets denominated in the world's reserve currency, backed by the rule of law and the most powerful economy on earth. Foreign investors tolerated lower yields because safety and liquidity had value. That calculus is changing. Other markets are developing. The Eurozone bond market has grown substantially. Chinese domestic markets, despite their opacity, offer higher yields. Cryptocurrency and decentralized finance, for all their volatility, appeal to investors seeking alternatives to sovereign debt. Gold has surged as central banks diversify reserves. The United States is not losing its reserve currency status overnight, but it is losing the margin of safety that allowed decades of borrowing without consequence. Each percentage point of yield the Treasury must pay to attract investors represents billions of dollars in additional annual interest expense. Each auction that draws tepid demand sends a signal about American fiscal credibility. The bond market does not make dramatic pronouncements. It simply adjusts prices to reflect reality, and the reality is that the United States government is now one borrower among many, competing for capital on terms it no longer dictates. For most of its modern history, the United States operated under an implicit assumption that there would always be enough buyers for its debt. Foreign central banks would recycle their surpluses. Domestic investors would prioritize safety. The Federal Reserve would backstop any temporary dislocations. That assumption was never guaranteed. It was a product of specific historical circumstances: the aftermath of World War II, the Bretton Woods system, the petrodollar arrangement, the collapse of the Soviet Union, and 30 years of globalization that funneled capital toward American markets. Those circumstances are evolving. The buyers are changing, the competition is intensifying, and the margin for error is narrowing. None of this means crisis is imminent. Markets adjust gradually. More often than they adjust violently. Yields may rise by 50 basis points rather than 200. Investors may grumble but continue buying. The Treasury may manage its auctions skillfully and avoid the dramatic failures that capture headlines. But the structural trajectory is clear. The United States will borrow more in the coming decade than it has in any previous period. It will do so while competing against corporations flush with growth opportunities and willing to pay for capital. It will do so with a buyer base that is more price sensitive and less strategically committed than at any point in recent memory. The question is not whether this changes the landscape. The question is how quickly and who adapts first. In finance, the advantage rarely goes to those who react after the shift becomes obvious. It goes to those who understand the system before the system reveals itself. $38 trillion is a large number, but numbers alone do not tell the story. What matters is who holds the debt, who is competing for the capital, and what happens when supply exceeds willing demand. In the end, this is not about deficits going up or rates going down. It is about whether the United States can continue borrowing on terms that sustain its position, or whether the market will impose different terms entirely. The bond market has no ideology. It is only prices, and prices eventually tell the truth.